How's it going, investors? Welcome back to my channel. Today I would like to talk to you about a topic that is kinda concerning many investors at the moment, and this concern might explode this year in 2021. And this topic is if we are in a stock market bubble. So as you can see here, I started this channel showing that I build this. I'm kind of building a value, growth, and dividend portfolio with very solid companies that have very good earnings. It's a portfolio that is not beating the S&P 500 at the moment. If we look from the COVID crash, it's related in euro, so that because I'm an European investor, so I buy stocks, of course, also in dollar in the Nasdaq, but then I have to convert everything in euro because it's the currency that I actually use. And from this dashboard, you can see that I'm diversified in some sector, overexposed in tech. I have more growth than dividend stocks. I have 23% of my companies in euro and the rest in dollars. And these are the companies that pay me dividend. This is a kind of a portfolio that takes time to build. It doesn't generate much growth, but in the long term is a portfolio that will do well even in market crashes, and it will give me like a very solid asset to retire in the future. The problem starts when I look at the current indicator right now, and it seems that we are in a situation in which market could crash very soon. So I stumbled upon this graph. This is the Goldman Sachs non-profitable technology index. So basically it shows the companies that are not profitable, their value during the time and their profitability. As you can see, from 2014 we have been around this value of 90. We had some ups and downs, but after the Corona crash we rallied until 400. So we had almost 500-600% gain in that direction. And what it shows is that most of these are companies that have no earnings. Some of them don't even have revenues, and people are just throwing their money at these companies. And we look, and of course, like some of these also have very good earnings, very good revenue. The problem is that their price is too inflated compared to the earnings. We always try to look at something called PA ratio, price to sales ratio, which is a number that tells us if a company is at that moment undervalued or overvalued. And this company have price to earning ratio that are over the roof, really extremely high and speculative. And if we try to look at which companies, like you might know all of these companies, like top one we have Plug Power, then we have Neo, very good company but extremely exaggerated in terms of price, Pinterest, Roku, Teladoc, Peloton, CrowdStrike, Zillow. As you can see, these are all very good companies that will do well in the future, but their current valuation is priced in for the next 10 years. And you can say, okay, but what's the issue if you want to consider the valuation of the company in the future right now? The issue is that if you already consider the valuation of the company in the next 10 years right now, the next 10 years will be will be very low to no profitability for this company in terms of price action for you. So the last year we had a surge in this company. This thing will not be able to be sustained, and in the next decade you will see very diminishing returns for investors that invested in these companies. That's the issue with that. And the problem starts with the fact that people are FOMOing in this company because they see other people getting rich. They see other people buying in these speculative companies, some people buying in penny stocks, and there is nothing more annoying, right, than seeing your neighbor getting richer. So, as Goldman Sachs wrote here, the reality is that Chinese electric car company Neo and hydrogen companies like Plug Power are the real vehicle of this speculative bubble. And it's of course like among them there are very good companies like Cloudflare or Roku, or even Spotify that will become like a leader in audio, but still their valuation is over the top. So if we look at what is valuation that we always try to look at to understand if a company is overvalued or undervalued, that is the P/E ratio. Let's start looking at the S&P 500 historical prices. As you can see, we started trading more than a century ago, and the price of the S&P 500 always goes up. So as you know, if you want to invest safe, you put your money in an ETF that emulates the S&P 500, and your money over time will go up. They will not do 10x in 1 year, they will not do 10x probably in 5 years, but you are sure that your money will keep growing. The problem comes when people try to FOMO in stocks to get rich quick, and that's what happens is that your price to your price to earning ratio goes to the roof. So here you can recognize two patterns that we already saw in the past. One is in the tech bubble in the year 2000, when the price to earning ratio went to 44. So for whom is not familiar, the price to earning ratio is just the ratio between the market capitalization of a company. So let's take Apple. Apple has a market capitalization of 2 trillion, so 2000 billion. And you divided this by the revenue, and the revenue of Apple is around 54-60 billion, so you will have to divide 2000 by 54 and you will get something around 40 or 36. So this is the current price to earning ratio of Apple, for example. And you see that during the tech bubble, most of the companies reach a price, and the average of the companies reached a price to earning ratio around 44. We were in bubble territory because averagely the S&P 500 during a century traded around 15-16. So there was an extreme high valuation that we even surpassed in 2008, and we are approaching right now in 2021. So we are in very dangerous water at the level of 38.71. So I showed you before the price of the S&P 500, and you might have thought like, okay, but we're still going up anyway. It doesn't matter if we have higher price to earning ratio. Yes, but it's also true that the current valuation is pushed not anymore really by value, because value comes when companies are good and generate good earnings, is pushed by helicopter money from the Fed. The Fed is the one that is printing money at a crazy rate and pushing the stock market at the moment, and you can see this by the inflation adjusted S&P 500. And remember the picture that I showed you before with the value of the S&P 500? We were in the tech bubble, the price of the S&P 500 reached a peak of 1,500. But if you look this from an adjusted inflation point of view, looking at the high of now, the value of the tech bubble was over 2,000, actually 2,200. So from the year 2000 till now, we didn't grow so much as we expected, because most of the value that of the S&P 500 got lost in the inflation because of the huge amount of money we are printing. So this is nuts. So where are the profits? Why people are speculating so much in companies that generate no profits, but keep going up? And the reason is that we live in an era in which digitalization is the most important thing, and the easiest thing to do is to buy a stock that will 10x in one day, that will 100x in 1 month. And you go to YouTube and you just look for some videos, advice about how to invest, and you stumble upon crazy stuff like 10x your money, like 10x stocks 100%, 10x your money, best stocks to buy in January 2021. This guy makes a video every month about how to 10x your money. So every month with this guy you can 10x your money. I'm an idiot because I'm investing in solid companies that do maybe 5 to 6% per year. This guy does 10x every month. In the amount of 12 months he does 1200%. Actually, that's not true. We should kind of compound this 10x. It will become a huge amount of money. Imagine if this guy is really able to do 10x every month, every single guy of Wall Street will be at his feet. Then this 0.21 cent stock is undervalued and will 10x. Or buy these stocks. Also, Katie Ark invested in this stock. Every video has now the face of Katie Wood on it, because she's a god, and everything she invests in is something that will become gold. Best stocks to 10x your money, or 10 mega X stocks, like Meet Kevin always has the next Tesla, because there is always the next Tesla. You missed out on Tesla, there is the next Tesla. You missed out on the next Tesla, there is even a cheaper next Tesla coming soon, or there is the next Neo, or there is the next Nikola. Mark Cuban's is 100x upside for $7. That's the other thing. Most of the time I see videos of companies that have a market capitalization of already 20, 30 or 40 billion, and people think that can 100x. Now that's the issue with people that come new in this world. If you start investing today or you start investing the last months, you might not know what is the meaning of many of the indicators that we study, like PE ratio or market capitalization and stock price. You just see a stock that is valued $1 and you think, okay, Google is 1,800, so this stock can 18x basically. Or $1 can 1,800x basically. But people don't see that the real value of a company comes in their market capitalization. And the market capitalization, for example, of NIO is 90 million, but people still think that this company can 10x. 90 billion means like the company will have to go to a 900 billion. 900 billion market capitalization is higher than the market cap of Tencent, Alibaba, Facebook and Tesla. And NIO, you might say, okay, Tesla reached that value. Yes, but Tesla has like 10 times the revenue of NIO. And Tesla is not only an automotive company, but it's also an energy company. NIO is an automotive company. It doesn't produce battery, it doesn't produce solar, it produces cars. NIO should be evaluated with companies in their sector like Volkswagen and Hyundai and the rest, not like Tesla. And you see here, this is the next Tesla, Lucid Motors, or like 4 monster growth stocks. I mean, as you can see, you can find a lot of this video here, and there is always going to be the next penny stock to buy that will 10x and will 100x. So don't follow my advice. Don't try to buy in solid companies like I do. I have, for example, in my portfolio, I can show you, I have Tesla, Store Capital, AbbVie, Alibaba, Johnson & Johnson, Microsoft, Starbucks, Adobe, Coca-Cola. Don't buy this company. These companies will not give you the return that a 100x company can give you in 1 month. Follow these guys. If you really trust them, follow these guys because they know what they're doing every month. I mean, if you really know a stock that does 100x every month, 10x every month, why do you do YouTube videos? This is the question. But then we can go even more extreme into this, and recently we stumbled upon like some TikTok new advisors that tell you what is the real strategy on how to invest in money. So now TikTok, the paradigm is shifted from YouTube videos that show you 10x or 100x company to TikTok stock advisors that gives you the real strategy on how to invest. And the problem is that many people will watch this and will believe it. So let's watch it together.
So how do we make money from home? For starters, this is not a sponsored video. We just get this question all the time, and honestly, the answer is really simple.
So basically, I just trade stocks on an app called Robinhood, which I left a link in our bio if you want to check it out. It's free.
Okay. So basically, they trade stocks in Robinhood, but they make millions trading the stocks. But anyway, at the beginning of the video, they leave you a link to check out their Robinhood account and get free stocks. So, okay.
Free to download, free to sign up. They actually give you a free stock, so they're paying you to sign up. But again, not sponsored. And I know trading sounds intimidating. Here's my strategy in a nutshell. I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it, and I do that over and over, and it pays for our whole lifestyle.
Okay, so this is the real thing about stock market. You have to buy when the stock is low and starts to go high, and then you sell it before it crashes. Okay, so this is called timing the market, and this is something that this guy says it's very easy to do, and it's very convenient because you can make lots of money on it. Okay, so I'm an idiot because I don't know how to do that. I don't know how to time the market. It's probably because I didn't study like this guy did. I don't have the knowledge to time the market and achieve that.
If you're wondering how much you can make doing this, in this month I turned about 400 into 14,000. And in this month, I turned less than 1,000 into 20,000.
This guy turned $1,000 in $20,000 in 1 month. So he might have bought a stock that 20x'd in 1 month. Like, I tried even to look at, like, for example, recently, many people are like crazy about bionanogenomics, BNGO. And I looked at the stock price that it went parabolic. And if we take like here the price range and we look from this is the month of December. Okay, in 1 month in December, it did, okay, 7x. No, it's not 20x. Let's keep going until we reach 20x. Here we go. So if we go to the top, so basically even the most speculative stock at the moment needed 2 months to do a 20x, but this guy managed to do it in 1 month. Okay.
And honestly, my favorite part about this isn't even the amount of money you can make, but just the fact that we don't have to go to a 9-to-5 job.
Yeah, we can focus on things that we actually enjoy doing. So if you have friends that like want to make money from home, you can tag them or send them a link. Or if you make money this way, share it in the comments so other people know like there's more people doing this now.
So okay, the real deal is to make so much money that you don't need to do your 9-to-5 job, because that's stupid, you know. So just do this trading, buy low, you have to start buying here and you have to sell here, because it's easy to understand when the stock will go up and when we start to go down, and this way you can stop doing your 9-to-5 job. So what I'm doing here with my portfolio, it's stupid, it's all wrong, but if you want to stay around, stick around and look for it, I will explain it to you. So basically what I'm doing here, it's a strategy called growth and dividend. So I have companies that I think in the future will perform very well in terms of growth, and companies that I think they perform as well, but not as good in terms of stock price, but they will pay me instead a dividend. And the company that I own are all solid companies that have very long history of earnings, very long history of dividends, and they are still big in their and they're still big in the current market, and then they will be big in the next 20 to 40 years, because that's the strategy. You want a kind of asset that from here to the next 20 to 50 years, depending on your time horizon, these companies will still be there, will still pay you dividends, and you can sleep safe. So I have I divided this in kind of growth and dividend. If we look at starting with dividend, I have Store Capital, Riot Company, AbbVie, very good company, the pharmaceutical, Realty Income, another real estate company, Gazprom. This is the only energy company that I own. It's basically related to a Russian company that provides natural gas to many countries, especially East Europe, and is building the Nord Stream 2, which will double their amount of revenue, and it means they will increase even more their amount of dividend. Johnson & Johnson, this one doesn't need an explanation. Poste Italiane, it's a financial company in the US, in Italy, that provides basically users the possibility to have bank accounts and cards for payment system, and it's really very well in terms of dividend and growth. Unilever, it's one of the 10 sisters with Coca-Cola, so companies that are in the food business, and they own many of the brands that you actually use every day. I mean, you don't know, but Unilever owns Ben & Jerry's, Axe, and Dove, and many other products. Coca-Cola doesn't need a presentation. Frankfurt Airport, it's a company that I think will explode soon when we will start flying again, because you can buy airlines or aircraft producer, but at the end most of the money will go to the airports, where most of the people will have to travel or to have flight connection, and this will generate huge revenue, and I think they will restate their dividend. AT&T, I believe this company has some risk, but with HBO Max growing and the movies of Warner Media being released in the theater and the HBO Max platform at the same time, I think this will increase a lot the number of subscribers. Then we go to growth area, and these are companies that I believe they will grow a lot in the next future. Unfortunately, I have Tesla as a bit of overvalued in my current portfolio. It's taking like more than 30%, but was not like this. It started with lower amount, but it just grew too fast, and I will have to consider if I have to want to rebalance this thing. Then we have Automatic Data Processing, a company that gives like processing system for companies. Alibaba, don't need a presentation. Microsoft, very great company that everybody should have in their portfolio with gaming and office system. Starbucks, which I currently paid at a premium. It's very high in price, but also a company that in the future I only see growing. And Adobe, which I feel like it's one of my favorite products, what they create. So anyway, I do believe this company will do well in the future. And this company didn't provide me huge returns. In fact, with some companies I'm still in red. This is also because most of these companies are in USD, and I buy in in euro. So when the USD euro valuation decreases, I lose money also there. But nonetheless, these are amazing company. We can look at the PA ratio, like we can do it from largest to smallest, and you can see that if we are taking back that chart and we look what's the current PA ratio, it's around 38.71. You can see that I have only 4 companies that are at the moment overvalued, and this is the PA ratio of last year, so it's not the forward PA ratio. I believe that this year the PA ratio of Tesla will go below 100 and the PA ratio of the other 3 companies will go below 40. So as you can see, I invest in solid companies that can give high return good return in the future. It's not speculative. I'm not gonna become a millionaire doing this, but I can assure you that from here to 20 years, this company will still exist, will pay a higher dividend, and I will be able to retire safe. So going back to the original question, are we in a market bubble? So we are in a in a no earning market bubble. So in a bubble in which most of the companies that are going high are companies that don't have any earnings, or their earnings it's too high compared to their stock price. So what to do now is that we don't know when this bubble will pop. So like as we said before, if we look at the PA ratio, we are still far from the tech stock bubble in 2000 value, very far from the 2008. But this will have to be also adjusted by inflation. And if adjusted by inflation, by looking at the Schiller PA ratio, we see that we passed the 2008 value and we are getting very close again to the tech stock bubble. So the bubble could pop soon, but will probably likely pop later this year, because we still have a lot of helicopter money coming from the Fed. We have the big stimulus plan from Joe Biden, about $2 trillion, and this will push the stock prices higher and higher. So at the moment I would say we could be either here or here, and be careful. This can go high, can make you rich, but exactly the moment when you will think that everything is fine, that the economy is good, then is the moment which the bubble will pop. The bubble will not pop when you think that everything is gonna go down. The bubble will pop when everyone will be bullish and everyone will think that we're gonna do great in the future. So my strategy is to continue on buying great value companies, great dividend companies that at the moment didn't recover well from the COVID crash, because these are the companies that will do well in the future. Thanks for watching. I'll see you in the next video.